Hello and welcome to Algorithm Stock Trading. Welcome to the channel. Today we're going to be talking about trading specifically Renko charts for the US Tech 100 CFD. If you can look here, I've pulled up an indicator. This is the CM Renko Overlay Bars indicator by Chris Moody. Basically what this does is it plots the open and the close of the new Renko bars, or where they would be over top of the actual candlestick chart. And this is extremely useful because it lets you see the Renkos as they're forming and when they're about to form, and you can follow the candles within the Renko bars. So this is what I've been using for a couple weeks now. Now what I did to find, I used the traditional Renko bars rather than the ATR based. So if you don't know what Renko bars are, basically if you go over to the 1-day chart here, because I'm not subscribed to TradingView, Renko bars are only available in 1 day unless you use this indicator by Chris Moody. But if you go over to Renko here, let's change the ATR or the brick size. Let's go with ATR based bricks. So basically, every time the price goes up by a specified amount, which in this case it would be the ATR, a new brick is formed, and this is extremely useful for trend spotting. It lets you know when the trend has begun and when it's ended. Now, with the ATR-based bricks, you're trading at the speed of the market. Now, the issue with that is because the ATR changes constantly, the average true range of the stock, the brick sizes change constantly. So what I do is I find the ATR. So let's go back to the normal candles. Let's go to the 15-minute chart. And then let's add the ATR on top. You can see that the average true range is a little bit between, let's zoom out a bit here, 8, maybe down to, yeah, about 8 up to 20. So what I like to do is I sort of pick a value in between the low and the high of the ATR over the last few periods. And what I decided to go with was 10, just because it was a little lower than 15. And yes, it was more volatile, but I found that it worked for this specific CFD. So let's go back to the 1-minute chart, show the Renkos again. And it says here that 0.001 is multiplied by whatever setting you choose for the traditional brick size. So for 10,000, it would be a brick size of 10, which is exactly what we want. And if you look, you can see that this begins at about 7,600 and then goes up to 7,610. So each time the stock moves by $10 in either direction, a new Renko bar is formed. So we're actually trading at the speed of the 15-minute ATR right now, but we're using the 1-minute chart. This is extremely useful because it lets you see all the candles within each Renko bar rather than having to wait 15 candles for a new Renko bar to form. So what I've been doing is I've been sort of cheating a little bit. I've been, rather than trading once the new Renko bar is formed, I trade slightly before the Renko bar is formed. So if you come back here, I would have traded about here, and I would have got out I would have followed this all the way up, and then I would have got out over here. So this is actually, it would have been a very, very small gain. Now, if you had traded as soon as this crossed here, you would have had no gain at all. Now, if you had traded up here, after the second Renko bar formed, you would have had a loss. And if you had traded slightly before the first one formed, you would have had a slight gain, compared to trading right at the end of this Renko bar and right at the end of this Renko bar, which would have been nothing. Now, I've done a couple tests. I've done some back tests. I've programmed in a couple things here. And if you look for the US Tech 100 over the last 2.5 years, now this number right here is obviously unrealistic. This doesn't include slippage or commissions. And this assumes that you get right in as soon as that Renko bar forms, or a couple pips before it. So don't expect to make trillions and trillions of dollars in just 2 years, but these are the numbers that are important here. This means that 72% of the time you were trading in the right direction. You were holding in the right direction. And out of all the trades that you started and ended, you won 61.8% of them over the last 2 years. So let's go back over here. So that means if you zoom out here, it's a little bit choppy right now, but if you zoom out way, way back, we would have won this trade, all the way down to here. And then we would have won, or we would have had a small loss here. It's a bit choppy. We would have had a small loss here, a small loss here, about even here, maybe a slight gain. We would have won this trade. So let's say you get in slightly before the end of this Renko bar, or when it forms, you get in here. You follow this down, follow it up, and then you get out here. That's a slight gain. Or if you had gotten in at the end of it forming and then at the end of this one forming, you wouldn't have had any gain or any loss at all. So what this does is it minimizes your losses and maximizes the amount of time that you spend in a winning trade. Now you can use this as your main indicator, and then you can use other indicators on top of it as your confirmation indicator, or vice versa. So I've been trading with CMC markets. And I started a couple weeks ago with just $200, and now I'm up to 285, which is a bit, it probably won't happen again that quickly, but it shows that so far it's been working. And basically what I do is every time I make a trade, let's go over to the NASDAQ 100. You get in, see where this orange arrow is? That's where I got in. Then I set the trailing stop loss at 1.75 times the brick size. So the brick size is 10, which means I'm going to set the trailing stop loss at 17.5 points. Now, you don't have to use a trailing stop. I like to use trailing stops. You could just use a normal stop order, and you don't have to use 17.5. You could use 20. Rather than 1.75, you could use 2, which is 2 bricks. And what I mean by that is it goes up here 10, 10, 10, and then down 10, and then down 10. So from here to here, it actually goes down 20. Now, if you use 17.5, you might get in here, and then out here versus getting in here and out there. It's a little bit more risky to use the 17.5 in some situations, but it helps you. Rather than taking a loss of 10 cents, you might get a gain of 10 cents or something like that. Now I'm also using the MACD and the RSI, the moving average convergence, divergence, and the relative strength index. And I use these as confirmation indicators. So if I'm going to get into a trade here, this probably wasn't the best example right here. But if you go back, let's say right here, it crossed over the 50-day or the 50-minute moving average. The MACD was going down. And the RSI was also going down. So you can just use those as confirmation indicators on top of the Renko in order to help you get a better understanding of uh, whether or not you should get in early into the trade or get out early. But if you want, you can just stick to using the Renko. Now I'm actually using Heiken Ashi on top of the candlesticks here. Heiken Ashi is also extremely useful. You can see that in a downtrend you'll have more red bars going down than green bars going up. It'll be maybe 5 steps forward, 3 steps back, 4 steps back, 5 steps forward, 4 steps back, stuff like that. So I hope you found this video useful. Let me know if there's anything I should do in the future, what you guys think. I'll be making more videos. Thanks. Have a great day. Bye.